FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
Welcome. You are listening to the Financial Survival Network. I'm Kerry Lutz, and today is 3/12/20. Well, with all the craziness going on, who would have thought that they might be proposing tax cuts or incentives to get people to spend, because we don't want to wind up like China, do we? Well, there's a lot more to that story as well. We ask you to email us what you think about the prospect of tax cuts. Are they going to do any good? Are we too far gone? What is the deal there? Email address is kl@kerrylutz.com. Well, right now we're bringing on Anthony Saccaro, who will fill us in more on the prospect of tax cuts. Anthony, it's great to have you back on. So I heard potential payroll tax holiday, which will amount to a 7.5% tax incentive. What have you been hearing?
Yeah, hi, Kerry. Thanks for having me back. Love being on FSN. I've heard a lot of different rumors. Payroll tax is certainly one of them. The lowering the income tax in some regards, even giving credits or incentives to, get people in the stock market. The reality is I think over the long run, I think the political environment, the economic environment, and the financial system, the world of Wall Street, I think needs to do just a better job of educating people about stocks and so on. And the reality is that most people, Kerry, don't understand the political implications behind the stock market, and most people don't understand the bias that occurs behind the stock market. It's almost like you feel like everyone has to own stock. That's, if you don't own stock, then it's almost like you're the black sheep. You're an outlier.
Yeah.
And I don't believe that. I don't believe that everyone has to own stock. I think if you're younger and you've got 30 years ahead of you, I think it's a great way to go. I think it's probably the best way to go. And that's certainly who these tax incentives are going to incentivize. But when you get a little bit older, you get within 5 or 10 years of retirement, or you even get in retirement, owning stocks could be detrimental to your financial health. And there's not a lot of education about that. Most people don't know that there are other ways. So I think it's good that the incentives are there, but I think better than the incentives is education.
Mm-hmm. So education, and how do you get educated here? What is the best way to do this?
Yeah, that's the question is how do we do that? I mean, I think maybe we start in the high schools. How about having courses in college? I mean, they don't have, in high school, they don't even teach you how to balance a checkbook, right? You talk to people today about balancing a checkbook and they don't even know what that means. And why should I balance my checkbook? So, education could start at the lowest levels in high school and then even in college have some, financial courses. But you look at the millennials today. Okay.
Do I have to?
Is that
do I have to?
Yeah, I know, right? Exactly. Yeah,
I really don't want to look at them.
That if you look at the millennials today, the millennials are in their late teens and all the way into their mid-30s. Well, you think about it. A 35-year-old millennial today was, 15 years old at the beginning of the century, 20 years ago. And if you look back at the last 20 years, we've had a tech crash in 2001 that lost 50% of the market. We had a dot-com crash that cost the market over 60% in 2008. And overall, the historical average for the last 20 years for the stock market is right around 4%. I mean, it's nothing to rave of. And so you've got these millennials that are 35 today, where the first 20 years of their existence on this planet was listening to mom and dad in 2001 and 2008 worry and lose money. And a lot of millennials want to have nothing to do with the stock market. So that's an issue, considering the fact that this is a much bigger generation than even the baby boom generation. So, I think the education starts at the lower level, high school and college, and talking about things like dollar cost averaging. I ask people every day if they know what dollar cost averaging is. One of the best ways to be able able to invest in the market for 20 or 30 year period of time. And most people couldn't even tell you what dollar cost averaging is. And if they can, they have no idea why it works.
Do you think more people know it or less people know what dollar cost averaging is as opposed to who's the vice president at the current time?
That's a good question. Yeah, that's a great question. The reality is I'm still going to guess that probably more people know who the vice president is than dollar cost averaging.
Well, I don't know which is worse. The few people that know who the vice president is, or the few that know what dollar cost averaging is, right?
Yeah, that's right. I think for the long-term health of that individual, I think knowing what dollar cost averaging is a much more important thing to know than who the vice president is.
Yeah. Well, that kind of goes with the power of compound interest, which Einstein, I don't believe he said it, but purportedly said was one of the most wondrous laws of nature, the law of compound interest, right?
Yeah, I've heard him say that. I've heard him say it's like the eighth wonder? Eighth wonder in the world or something like that. So whether he said it or not, I don't know. But I do agree that the point behind it is that compound interest is absolutely huge. I mean, if someone starts saving $100 a month at 20, and they look at that number at 60 years old versus waiting 10 years and starting to save, I don't have the exact specific numbers in front of me, but there's a significant difference just by starting early and just saving a small amount every month. But guess what? You don't hear that in high school. You don't hear that in college. You don't hear any of that stuff of just trying to set aside $100 a month. That's it. And but you got to start at 20, not at 40.
Yeah. Oh, well, too late for me.
You and me both.
Yeah. So I'll have to save $10,000 a month to get where I would have been if I had started when I was 20. So it ain't going to happen. But
I'm with you.
Hey, it's just the way it works. But financial ignorance. So what you're talking about is financial literacy, of which there is a way too little of in the world, right?
Oh, 100%. I mean, there's virtually zero financial literacy. Most people that I talk to, whether they call in off of my radio show, whether I just see them one-on-one, whether they come to some speaking engagement that I'm doing, I mean, I'm interacting a lot with people just like you are. And the reality is that most people that I talk to have no clue about economic concepts. They have no clue how basic things that you and I would think are basic, like quantitative easing. You mentioned quantitative easing to someone, they don't even know what that means. And that's a big deal. They don't understand stock buybacks. I mean, stock buybacks have been the number one driver of the stock market for the last 2.5, 3 years, and they don't understand the implications of stock buyback. The fact that all these companies, more than half of the S&P 500 companies, have been borrowing money because the feds have kept the rate so low. So these companies borrow money, they get into corporate to debt over their heads to buy back their own stock. And and part of the reason that they do that is because it inflates the EPS, the earnings per share. And it's an artificial inflation because what you're doing is when you take stocks out of the marketplace, but the earnings stay the same, then the earnings per share goes up. And that's supposed to be an indicator of how healthy the economy is, or how healthy the company is. But the reality is that it's an artificial way to manipulate the company's EPS, the balance sheet. So it makes it look like the company's doing better, which then in turn causes the company's executives to get higher bonuses, because more than half of the companies in the S&P 500 pay their executives based on the earnings per share. And by buying back stock, companies are artificially manipulating the EPS. So people don't understand that this is what's going on. And if I have a half hour to explain it with someone, I get most people putting their hand on their forehead going, I had no idea. And unfortunately, that's America, that most people have no idea because there is not that basic education. You're not going to get it from Fox or CNN.
No, you're not. You're not at all. There can be valid times for a company to buy in its shares, but for the most part, it shouldn't be a regular practice. They should be looking for, rather than, they should either do a dividend or they should be looking for more opportunities to invest in their core business. And if they can't find them, then maybe it's time to liquidate the company and return the proceeds to shareholders.
FSN Radio. It's all about what's next.
Financial Survival Network is brought to you today by Orin Resources, a junior exploration company with the appetite of a major. It's hot on the trail of the next globally significant discovery, creating enormous potential upside for you, the shareholder. Orin is one of the most aggressive exploration companies pursuing high-grade, scalable gold and copper deposits, and has a premier 7-project portfolio, including its 2 flagships, Committee Bay in the Arctic and Sombrero in Peru. Orin's unparalleled technical team and highly experienced management has a history of success in advancing and monetizing exploration assets. No wonder Orin's been called one of the best in the junior exploration sector. Orin trades on the TSX and the NYSE under AUG. To learn more, go to orinresources.com. That's AURYN resources.com.
The Financial Survival Network. It's all about what's next.
Oh, 100%. I agree with you on all fronts. And you're right. There are legitimate reasons for companies to buy back their own shares. I'm not trying to give the impression that they're not, but there are illegitimate reasons as well. And I'm going to take a wild guess after having done a lot of research in this. The fact that that probably 95% of all the share buybacks that are done for illegitimate reasons. And again, it boils down to the fact that over half, I don't think it's quite 3/4, but somewhere between half and 3/4 of the companies in the S&P 500 pay their executives based on the earnings per share. And so they want the earnings per share to go up. I'll give you just one example that I did study. McDonald's. McDonald's from 2014 or so to 2020 borrowed enough money to buy back their own stock that they went from $15 billion in debt to $25 billion in debt. So increased their debt by 65% or somewhere in that range. But over that time period, their revenue went down by 12%. Now, if I bring anyone with no financial knowledge, a company, and I say, look, the debt has increased by 65% over 6 years and the revenue went down by 12% over 6 years, what do you think should happen to the stock price over that time? And I've asked this question hundreds of times to individuals, and they all say the same thing. Well, it should go down. But the reality is it didn't go down. It almost doubled over that time period because of the artificial nature of stock buybacks. They use all that money to buy stocks. It creates an artificial demand for the stock. When there's a demand for the stock, it goes up. But it's artificial. And yet the sad fact is that 80% of a McDonald's executive's pay is based on the earnings per share. So they don't care how you get the earnings per share up. They're getting paid based on it. So they're borrowing money, putting the company in trouble, and buying back all the stock so that their EPS goes up. But not only did they not create any other revenue, not only did they not sell another hamburger to get that EPS up, the fact is they lost revenue over time, but the earnings per share still went up, and that's how they get paid. So we're seeing a lot of what happened in 2007. We're seeing it happen all over again, and that's scary. And then when you realize that corporate debt is at record levels, it's just going to take one company to go bankrupt to get the people to realize that this is what's going on. And once that happens, it's not going to be good times ahead.
This is a real emperor has no clothes moment coming. And hey, if you would ask people, what do you think should have happened to the CEO's salary in that scenario, they would have said it should have been cut. And yet he wound up getting many times, or she did many times more than they would have gotten otherwise had they not done that manipulation. I once saw a book, Anthony, called How CEOs Manipulate Their Financial Statements. And it used to be there was a limited number of ways to do it. And everybody knew about them, and they were almost within the range of acceptability. Ways to accelerate revenue, to recognize it earlier, ways, to minimize your write-offs, etc. And the government makes all this possible because you're allowed to keep 2 sets of books, one for your tax accounting and the other for your financial or shareholder accounting. And it just leads to a lot of fraud and we've been living in a fraudulent world for a very long time, and it's all going to come home to roost now.
Yeah, it's all got to come home, and that's the thing is stock market's had a good run. Matter of fact, it's had the best run ever from March 9th of 2009, the bottom of the stock market, until I believe it was August of 2018. So we're a year and a half past August of 2018 at this point. But from March 9th to August 2018, the market had the longest bull market this country's ever seen, and now we're a year and a half beyond that. And a lot of investment planning and financial planning is common sense. And from a common sense standpoint, you can just ask yourself, does anything go up forever? And we know that the answer is no, that, at some point there's going to be some major corrections and crashes. And yet this corporate debt bubble has been building this whole time. And, now we have the coronavirus, which, it's something that we didn't see coming. Yet the crash of 2008 was preceded by something we didn't see coming. The crash of 2001 was preceded by something we didn't see coming. So that kind of falls in line. But, a month ago, Corona was a beer. Today it's a virus. So, bottom line is that this coronavirus, my fear is that, as it starts to shut down business and starts to shut down, companies are now canceling, mass conventions. The airlines are doing horrible. You throw in oil, and the oil companies are doing horrible with some of the negotiations that have fallen apart on that front. You throw in, a lot of the effect. People aren't going places. Public venues are starting to empty. So you throw that in, and that immediately halts or decreases revenue for companies. And at some point in time, depending on how long this goes and how much cash the companies have, at some point in time, they're going to have to start laying off people. And if it keeps going worse, then the companies with the highest debt at this point are not going to be able to pay their debt. And those are the companies that, as you mentioned earlier, are going to have to are going to file bankruptcy. That it's only going to take one company to get this whole thing to blow up. And the coronavirus could be the start of that. So the virus itself is not causing the crash, but it is going to cause a loss of revenue. And that may itself create that domino effect that then results in another 2008-like scenario.
And the panic that has ensued. Look, I'm looking for coronavirus travel specials. There seems to be a lot of them out there.
Yeah. Oh, 100%. Yeah, absolutely. One of my friends was saying that if he wants to fly to Italy now, it's like $300.
Yeah, unfortunately, they won't let you land. That's the negative.
Yeah, exactly. So that's exactly right. But you're right. There's a ton, and I'm not worried about it at all. The media is making a bigger deal of it than it is, and I don't want to downplay it. And certainly the people that have gotten sick from it and the people that have died. I don't want to downplay that.
I know what you're saying. Yeah, but it's not the Black Death. It's not the Black Death.
That's right. It's a cold. The doctors are, all the doctors out there, even on TV, and are saying it's like a common cold. More people die from pneumonia than this. People die from pneumonia every day, more than this.
Yeah,
more people die from the flu than this. If you are infirm and sick and you get the flu or pneumonia, you're going to die, or you can die. So this is no different than anything else. It's not like you get it, you got to go to the hospital and you're going to die. That's not here. It's not the Black Plague like you mentioned. So the media is hyping it, and I have to ask myself, Kerry,
why?
That is a lot of this political. Do they really want this thing to drive the stock market to the ground so that it hurts Trump? And is that why the media? Because it's no secret that the media doesn't like Trump, right? I think that's pretty well known. So
yeah, is that true?
So are they really trying to make it so that Trump can be hurt?
Wait a second.
So. I think there's a lot of truth there.
Anthony, you think the media doesn't like Trump? What would make you say such a thing?
Where do I get that idea from?
God, I just thought they're fair and balanced. Oh, wait. No, not all of them. Most of them are unfair and totally imbalanced or
100%.
Unbalanced. Just watch them all. Well, hey, Anthony, this is interesting times. When it all shakes out, we'll have you back on. Maybe we'll get together for a beer and talk about how it could have been avoided. Because it certainly could have. We had our opportunity in 2008. We had our opportunity in 99, 2000 with the crash of the dot bombs. And yet each time we chose the easy way out and the really dangerous way out. That's what we chose. And in the long run, the most injurious way out. And that's what we're trying to do now. But at some point, it's not going to work anymore. Anthony, just tell us, where do we find you? how do we connect with you on the web?
Yeah, absolutely. So our website's probably the best place. It's Providence Financial Inc., like INC, providencefinancialinc.com. All of our contact information there. We got a lot of good videos there, a lot of good information in general. And if one of your listeners has a question about something I said, they want to have a quick conversation, I'm certainly open myself up to your listeners. They can always call my office or email us through the contact site on our tab, and we'll be in touch with them. I'd love to help anyone I can.
And we really do appreciate that and your generosity. People need all the help they can get in these times, Anthony. Really do appreciate you coming by. Hey, if you got a question for Anthony, you want to send it to us, kl@kerrylutz.com. That's the email address. Our Twitter feed is @KerryLutz. Our Facebook page is Financial Survival Network. And Anthony, I just want to mention one thing. In response to this coronavirus outbreak, the governor of New York is very proud that using prison labor that they pay 65 cents an hour to, they've been able to come up with hand sanitizer that is much cheaper and inexpensive. Who knows if it works like the rest of the things the government does? It probably doesn't work at all anyway. But on my Twitter page, I posted, I love the smell of prisoner manufactured hand sanitizer in the morning. We got to speak out against this. This is disgusting. The free market is perfectly capable of making all the hand sanitizer we ever could need. And of course, the government will lose money on this hand sanitizer. It will put out an inferior product and cause more mayhem in the marketplace. But hey, we really appreciate you coming on, and we will talk to you again soon. Be well, my friend.
Thank you, Kerry, for having me.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.